How would you like to invest in real estate without having to deal with tenants, manage properties, or pay for repairs? Well, today I'm going to teach you exactly how to do that with REITs or real estate investment trusts. I'll go over what REITs are, how they work, and whether they belong in your investment portfolio. Simply, a real estate investment trust or a REIT is a company that owns, operates, or finances income generating real estate. And what most REITs do is they lease spaces, collect rent, and then distribute that money to their shareholders. REITs were created in 1960 so that small investors could come together and buy large real estate portfolios, and they operate just like mutual funds but for real estate instead of stocks or bonds. Investors make money from either the REIT's dividend payments or when there's an increase in the value of the REIT's shares. And one of the biggest advantages of REITs is that they turn the traditionally liquid asset of real estate into a product that can be easily bought and sold on exchanges. And at the same time, they rid the investor of needing to manage their real estate properties themselves. There are many legal requirements that REITs must continuously meet, but a big one is that they must pay out 90% of their taxable income to shareholders in the form of dividends. So this means that REIT shares will tend to have slower growth than traditional stocks because they pay out more of their profits rather than reinvesting internally. But you as an investor can take advantage of that by reinvesting those dividends externally and then increasing your equity in your shares. For the pros of REITs, we have high liquidity, diversification, stable cash flow via high dividends, which is usually between 4 to 7%, and you have real estate exposure without the hassle. For the cons, we have low growth, dividends being taxed as a regular income, unless you have them in a tax advantage account like a Roth IRA, which I highly recommend. And then you have exposure to certain market risk, such as interest rates. Primarily, there are two types of REITs. There are equity REITs, which own and manage the properties. And then there's also mortgage REITs, which lend money via mortgages or indirectly with mortgage-backed securities. Then there's also a kind that's very rare, which is a hybrid REIT, which is a mix between the two. And mortgage REITs make their money mostly with their net interest margin, which is the difference between the interest that they earn and the interest that they have to pay to fund the loans. REITs are also identified by the property types that they engage with, such as residential, office, retail, industrial, healthcare, storage, and more. And it's a good idea for investors to further diversify their real estate by investing in REIT mutual funds or ETFs that will spread their investment across many different REITs of many different property sectors. And an example of a REIT ETF that invests in both equity and mortgage REITs with varying property types within it that I have personally invested in is VNQ, Vanguard's Real Estate Index Fund ETF. And then some alternative investments to REITs that you might want to consider and why include direct real estate investing or real estate crowdfunding platforms in order to try to get a higher return, dividend stocks to avoid certain market risk like interest rates, or bonds for lower volatility. As for who REITs are best for, REITs are best for investors who want steady income, exposure to real estate, and diversification, all without the work of directly buying and managing highly illiquid real estate themselves. And ideally, REITs should be within a tax advantage account like a Roth IRA to prevent the dividends from being taxed like ordinary income. If REITs or REIT ETFs sound right for you, you can begin investing in them just like you would with any other stock by using a brokerage app like one of the many that I've linked in the description. Personally, I recommend Robinhood if you're a beginner. And like always, make sure to do plenty of research before making any significant investing decisions. To recap, REITs or real estate investment trusts are companies that own, operate, or finance income generating real estate properties, and they provide a simple way to invest in real estate and earn passive income without needing to manage any properties yourself. Whether you choose individual REITs or a diversified REIT ETF like VNQ, they're powerful tools for income, diversification, and long-term growth, and especially when you hold them inside a tax-advantaged account. If you found this lesson insightful, I'd really appreciate it if you go and invest in that like button, consider subscribing to the channel, and check out these videos for more.